In this video, I'm going to cover the alternate version of exercise 10-10. We're addressing installment notes. Now, we've talked about notes in past chapters, but that's been instances where we paid the full amount, the principal and interest, in one installment. Installment notes, we're going to pay that principal and interest over time. So whether it's over several months within the same year, month to month over several years, or annually over several years, it would be a case more similar to a car payment or maybe perhaps even a mortgage. In this scenario, on January 1st, 2018, Eagle is going to borrow $35,000 cash by signing an installment note. It's a 4-year note, 7% interest, and the note requires an annual payment at the end of December 31st of $10,333. So every year over 2018 through 2021 on December 31st, they're going to pay $10,333, and that includes both the interest and the principal. Now, the setup of this problem is a little confusing in that they reference the present value and future value tables. Present value of a dollar, future value of a dollar, present value of an ordinary annuity, and future value of ordinary annuity. And they make it seem like you actually need to use those to solve this problem, and you don't. I'm going to go ahead and explain how you could use them just so you have that knowledge. It'll set you up a little bit more for your finance class later on. So if I did need to use the tables because they didn't give me what the annual payment was going to be, again, I won't test you on it for the exam, but if I did need to, I'd start out first with what's the full amount that's owed? What's the principal? That's $35,000. I'll give you a hint. The only table, we're going to divide it by a table value, the only table that we're going to need to use is present value of an ordinary annuity. Annuity by definition is a stream of money. It's happening more than one time. An installment note by definition is happening more than one time. So we're going to use the present value of ordinary annuity table. Now when I go to that, there's lots of numbers here, but don't worry. Where I'm going to look for is the column that corresponds to the interest rate, and that's 7%. So I'm going to use the 7% column. And then I'm going to keep going down. The rows correspond to periods of time. Since this is a 4-year installment note, I'm going to use row 4, keep going over until I intersect with my interest rate of 7, and my present value of ordinary annuity factor that I'm going to use is 3.3872. Again, let me go back. If I divide that present value of ordinary annuity factor into the principal of $35,000, I come up with the fact that the annual payment is $10,333. Again, if you want to prove it out on your own, that's fine, but they will give you that annual payment on your different problems. So let's go ahead and jump into what you will need to execute for the exam, and that's preparing an amortization table. Every single year, we're going to credit or pay cash, because keep in mind this company is paying it, so it'd be a credit to cash, $10,333 because it's an equal annual payment. Now, the work that I want to do is break that down into what amount is paying interest and what amount is paying principal, and that's going to be different every year. Where I'm going to start out with is what's the beginning balance on day 1, January 1st, 2018, and that's the full amount of principal or the note that was signed of $35,000. The first thing I'm going to do is figure out how much, again, of that $10,333 cash payment is going to be interest. How I do that is I take the beginning balance at the beginning of that particular year, which happens to be $35,000 at the beginning of 2018. We just borrowed the funds. Multiply it times the interest rate, 7%. This is for a full year, so I don't need to take it times a fraction of a year. And I get that the interest payment is $2,450 for just that year. Now you'll note you see here debiting interest. Think about this. You're making a payment. It's going to be a credit to cash of $10,333. You're also recognizing the interest for the year. Interest is a cost or expense of doing business, so you're going to debit interest expense of $2,450. The other part of this is I need to figure out how much of that $10,333 payment is actually paying off the principal of the loan, the $35,000. Keep in mind, $2,450 of it was paying interest. So to figure out the amount paying down the loan, we just simply take the $10,333 cash payment, minus the interest portion of $2,450, and the pay down of principal for 2018 is going to be the difference between those, $7,883. Now you notice here I mentioned debiting notes payable. A note is a liability, so when you're creating it, you credit it. When you're paying it down, you're going to debit or decrease notes payable. These both add up to $10,333, and that's what we want, but we get the breakdown of interest versus our principal. Now, I also want to look at what's the ending amount owed. Of the $35,000, when I get to the end of the year, what's the remaining balance? So I can simply take the beginning balance of $35,000 minus, again, the amount that I paid down a principal or notes payable of $7,883. And so the outstanding balance at the end of 2018 is $27,117. So I'm going to do similar calculations year to year. In 2019, the beginning balance is the ending balance for 2018, $27,117. To figure out interest, I'm going to take that beginning balance of $27,117 times the same 7% interest rate, and now interest expense is $1,898. To figure out the amount of that $10,333 payment that is going to pay down my principal or my notes payable, take the $10,333 minus the interest amount of $1,898. And so the payment down in 2019 of the note or the principal is $8,435. The outstanding ending balance is the beginning balance for the year of $27,117 minus the payment of the note or principal of $8,435. And so that leaves us with an outstanding balance of $18,682 at the end of 2019. The trend is going to continue that the amount of interest expense every year will lower, because keep in mind the principal that's owed, the outstanding balance that's owed, is shrinking. So therefore the interest amount that I'm going to record every year is going to be lower. And the principal portion, or the payment down of the note payable every year, is going to increase because it's the same payment. And if the portion of interest is going down, the portion that you're paying off the note is actually going to go up, but the outstanding balance is going to continue to decrease. Now, for the sake of time, trying to keep the video as short as possible, I'm not going to go through all of the calculations other than a note in 2020. Again, you're bringing your ending balance from 2019 of $18,682 times 7% gives you interest of $1,308. Subtract that from your credit to cash of $10,333, and you're paying down your note of $9,025. It brings your balance down to $9,657. Again, multiply that times 7%, and your interest in 2021 is $676. Again, subtract that from the full cash payment, and you get a payment down a principal of $9,657. Subtract that from the ending balance in the prior year, and you prove out that you've paid off all your principal. Some quick things to note here is the total amount of interest paid over the life over those 4 years is $6,332. The total amount of principal or note paid down over the life is $35,000. That's what we would expect. We signed a note for $35,000, so we'd expect over the life of that note we paid off the $35,000. The total cash payments over the life is $41,332. So of that $41,332, $35,000 of it is paying off the original amount of the loan or principal, and $6,332 of it is paying off interest. Again, year to year, the amount of interest expense is going to shrink because the amount of principal outstanding that you owe on it is shrinking. The amount that you're paying down the loan, the actual debit to notes payable, is increasing because that payment's staying the same and a lesser amount is interest. And again, at the end of the life of this installment note, you end up paying it off in full.